I have some largeable taxable gains on some positions, and they're not doing as well as the market and kind of poorly underperforming. What should I do about these positions?
Yeah, this has been a really common thing, especially in the taxable accounts that we have in 2020. The broad market indexes that I really like were kind of underperforming because such a big chunk of the economy was essentially closed down. Airline miles at one point dropped 96%. Some of these crazy things, energy and all of these areas dropped because people weren't moving around. And so all of that money started to be funneled into smaller areas. Innovative technology, genomics and clean energy were the three biggies. And we ended up with some phenomenal returns in those, but they peaked out in February of last year. And so, what do you do with that? It's very interesting, right? So, if it's in an IRA, we basically got rid of most of those and went back into a more diversified portfolio in the first half of last year, most of it in March of last year. So that worked out well because they've come down some more. But in the taxable accounts, you have these big gains. And so this is a really interesting question and a situation where, people want really no taxes in a perfect world and maximum returns. But when you have this, we're in the middle of a pandemic. And when you have these kind of cyclical things that are happening, and you had to go into one area that skyrocketed, made you a gain, and is now falling out of favor, you need to sell those. You need to take the gains as far as that goes. And so we have been very aggressively this year, certainly very aggressively selling those pieces and taking some of the gains. I'd rather have the clients call me up to take the money out of their account to pay the taxes than have the gains disappear. And so I think that's strategically, it is difficult to figure out when you should take gains. That's more of an art than a science. I will always give, fairly high levels of latitude to a position, especially one that's kind of cyclical, in hopes that it continues to rebound and come back. But honestly, if it gets past half of the gain, if I have an $80,000 gain and it gets down to 40,000, I'm probably going to take that $40,000 gain. Even though it's painful to pay the taxes, it's better than having that gain turn into 10,000. You're better off paying the tax. So sometimes that's an interesting, conversation with people. It's just this concept of, net rate of return after tax. And It's not easy. Generally speaking, taxable accounts, which is what I have set up now, my portfolios are more broad based, not so cyclical, not so up and down, and so they maybe we can hold on to those for the long term. The Vanguard Total Stock Market Index, the Vanguard S&P 500 Index, and these types of things that tend to be more bellwether, all weather type of accounts versus these more narrow pieces that we were kind of forced into in 2020. And so it's going to be a little bit of a painful transition because of taxation, but it is something really important to kind of understand that sometimes it's worth paying the tax. If you put tax as your number one criteria on an account that is taxable, lowering tax, first of all, you have to have a very special portfolio to make that work. And it's very likely that you might make less than you would if you were able to just look at it from a net after tax rate of return standpoint. And that's just my opinion, but that's that's been my outlook and what I've actually experienced here also.
For these positions, do you ever just, or there's like that short term and long term gains? So, like, when you do this calculation, are you thinking about like, hey, I'm a couple months away from a long term gain. Is it worthwhile just to risk it to wait till that 1 year hits?
Yeah, no, that's a good question. I hate short-term gains. Having said that, I have a lot of clients that are in a 15% tax bracket on capital gains and probably 24% tax bracket on short-term gains, ordinary income. The state tax might add another 2 or 3%. So you kind of have to look at that and what's happening right now, right? So am I going to wait 2 or 3 months and lose that difference? Because honestly, what is that 10, 11% difference? So 2 or 3 months, if you've got a position that's falling pretty hard, you lose that easy. So I'll take a 2%. I'll take a short term gain if I need to. Again, I try to, and this is not scientific, but I try to use kind of a half as the key. If I've got an $80,000 gain that's turned into $40,000 gain, um, whether short term or long term, and if I feel negatively about that position and it's really trending downward, I'm going to get out of it. Uh, and then also there's some future thought process. I mean, you have to think about it, like think about what's happening. So small cap stocks are taking it in the chin, especially the small growth stocks, which is not an unusual situation in a higher inflationary environment, because when interest rates go up, the multiples, those companies are selling for a lot more times their earnings if they have earnings, and so they tend to sell off in these environments even more. So again, it depends on the situation. It's not there's not a scientific rule of thumb there, but boy, I sure have watched a lot of people let gains disappear in order to avoid taxation. I think that doesn't make sense to me. I'd rather pay a short term gain if I had to.